U.S. and global dividends rose to record figures in 2022. This according to the latest Janus Henderson Global Dividend Index. However, higher rates may have already begun to affect companies' willingness to grow dividends, spelling trouble for growth in 2023. Here to discuss is Matt Peron, Janus Henderson Investors Director of Research. Matt, thanks for being here. As we look at companies, the big dividend growth that we saw last year and companies' sort of strategy with regard to dividend, now that we look back on it, did it feel like companies were really prioritizing dividends in what ended up being a declining year to try to get people to buy the shares?
Well, I think there's some of that for sure. I think the main driver was strong earnings growth. I mean, despite the fact that there was valuation compression in the market, the fundamentals were actually quite strong. You saw decent earnings growth, and that was passed through to companies to enable companies to increase their dividends.
Okay, and so with that, even further now, where can investors, and how should investors evaluate some of the dividends that have been announced and where we could still see more of the dividend increase or growth out in the market?
Yeah, so last year, most of the dividend increases came from the oil and gas and the financial sector. That was the large majority of the growth in dividends. We'll probably see a continuation of that this year, although we expect it really to slow down quite a bit. So maybe a bit more even, but still strong from those sectors. In particular, we expect. But at the headline number for 2023, we're really going to probably see muted dividend growth. Maybe just 2% is our current thinking. And that's because we really saw a lot of sequential decline in dividend growth as 2022 progressed, and we'll probably see that continue here into 2023.
And 2023, of course, already has shown itself to be a year in which companies are cutting back in other areas, right? Whether it's layoffs, whether it's CapEx, et cetera. In this kind of an environment, historically, what have we seen happen with dividends? You said, companies won't be raising by much. Do we tend to see them cutting that, or is that sort of the last thing that companies want to cut?
It's really the last thing that they want to cut. So I think your point is spot on in the sense that we're not going to, they're not spending a lot. They're not in a spending mode, right? But they do want to show that dividend increases, commitment to dividends and dividend increases. So they really are the last thing to cut. In the pandemic, we saw companies in the U.S. in particular, cut their buybacks first, maintain their dividends. So you didn't really see in the U.S. a lot of dividend cuts. You did outside the U.S., but inside the U.S. they protected that by cutting the buyback programs first. And that's probably what you'll see again this year. If it gets to be a tough year fundamentally, you'll see buybacks go, dividends maintained. They'll try and increase them a little bit. That's our forecast, just to show year-on-year increases, because that's important to investors.
For investors that are trying to make sense of whether a company is actually healthy when they make these dividend announcements, when they make the buyback announcements as well, what is the best way to go about that evaluation?
You really want to look at dividend coverage. Are their earnings, are they generating enough earnings to cover their dividend to continue to pay out? That's the number one factor you want to look at. And in general, across the U.S., you see pretty good dividend coverage. So you feel pretty good that the U.S. is able to continue to make these dividend payments, and potentially there's scope for some increase just at the current level of coverage.
Matt, I know this report had to do with dividends, but I'm also curious about allocation for stock buybacks, especially because that's been a hot topic as of late, and sometimes a controversial one if you look at through a political lens. But what do we see, again, traditionally about sort of dividend trajectory versus buybacks? We've already gotten a lot of announced buybacks this year, even in this sort of cutback environment.
Yeah, so buybacks are really more popular in the U.S. than outside the U.S. But in the U.S., there's quite an active buyback program. It's a very important tool to return cash to shareholders. Something that's been rewarded in the past, few years, even decade. Investors really want to see, good allocation, capital deployment in their companies that they own, and a commitment to buyback and returning cash to shareholders in general is very important. So I think you'll see that as a really important lever. And what's good about buybacks from a management perspective is that you can dial it up and dial it down as you feel that either the valuation of your stock is at a reasonable rate or level, or if there are stress or somehow earnings aren't coming through, depressed earnings, et cetera, then you can dial them down, as we saw during the COVID episode.
Matt, thanks so much. Appreciate your time. Matt Peron is Janus Henderson Investors Director of Research. Thank you.